Welcome to my YouTube channel. My name is Michael Mwansa Lioba. Running this YouTube channel, the executive outcomes. My presentation will be based on taxation of mining operations, and this is part 2. I hope you had started looking at part 1 so that there is continuity in what I'm going to discuss or demonstrate with you in this presentation. In Zambia, the estimation of mineral royalty is based on gross value or norm value of minerals. Today we are going to concentrate on the mineral royalties is our focus, and that based on the Income Tax Act, gross value is defined as the realized price for sale free on board at the point of export in Zambia or point of delivery within Zambia. On the other hand, norm value means the monthly average London Metal Exchange cash price per ton multiplied by quantity of metal, of recoverable metal, sold to the extent that the metal is not quoted on London Metal Exchange, or the monthly average cash price per ton at any other exchange market approved by Commissioner General. When we talk about Commissioner General, we are talking about the Commissioner General of Zambia Revenue Authority in this particular case. This is multiplied by the quantity of metal sold or recoverable metal sold to the extent that the metal price is not quoted on London Metal Exchange or in the metal bulletin. The gross value, which we hear of gross value, which we are going to use in this particular case, in certain cases, the gross value is applicable on industrial metals, energy minerals, gemstones, while norm values are applicable on base metals, including copper and precious metals. For tax purposes, minerals are classified into a number of broad categories. These include copper, base metals other than copper, such as iron, nickel, lead, zinc, cobalt, titanium, tin, aluminum, to name a few. We also have precious metals such as gold, platinum, silver, palladium, selenium, etc. There is also what we can have as gemstones. These include amethyst, aquamarine, beryl, corundum, diamond, emerald, to name a few. The list also continues. We have industrial metals such as limestone, sand, gravel, gypsum or talc, etc. I wish to bring you to attention that in the 2023 national budget, the government of the Republic of Zambia amended the calculation of mineral royalty for copper. This was a result of a number of contributions or complaints from various stakeholders that stressed that mineral royalty tax were not sensitive to operational costs. The stepwise application of the rate to the aggregate value as opposed to the marginal value in each band increased payment distortion. That's what was their main claim. For instance, small differences in copper prices had significant threshold effect on revenue payments. For instance, a small change of $1 from, say, US dollar 7,499 dollars per ton to US dollar $10,500 would consequently lead to what was perceived as an increase in the effective tax rate from 7.5% to 8.5%. Now, in order to minimize distortion, The 2023 national budget restructured the mineral royalty regime with respect to copper, as the tax will now apply on the incremental value such as its adjusted price band as shown in table 4 below. Marginal rate sliding scale for copper will be applied. So this is what you need to be aware of when it comes to calculating the mineral royalties for copper especially. Now, to look at how we calculate mineral royalties, I'm going to start by looking at a simple example that will show us how the mineral royalties are determined. So we have example 1, which has Lumpuma Mining Company carries out its mining operation in Kalurushi district of Zambia. It mines cobalt, base metals, and industrial minerals recoverable under license. What are we required to do here? What is our task? Our task is to use the tables below for the first quarter of 2023 to calculate the mineral royalties. So how are we going to do that? So that's what I'm going to show you. We have table 3, applicable mineral royalties. We have in here the base metals other than copper, which are valued using norm value, and the applicable royalty rate is 5% for these base metals, but for cobalt, which is part of it, it is 8%. We have looked at this in this manner, or it is cast in this manner, because the mineral royalty for copper, as the amendment in 2023 budget, will be calculated different. That's why you have an exception there. Then for precious metals, you have the valuation basis being the norm value, and the applicable royalty rate is 6%. For energy minerals, the valuation basis is gross value, and the applicable royalty rate is 5%. Whereas gemstones, based on gross value, the applicable rate is 6%. For industrial minerals, it is the valuation is based on gross value, that is again attracting 5%. So we also have the norm and price values per ton. Okay, in this particular example, we are given that cobalt in January 2023, cobalt norm value per ton, okay, or US dollar is 4,800, and January for base metals, the norm price per ton is US dollar 4,000. For industrial minerals, which is based on gross value as seen in the table above, it is gross value per ton, and the US dollar is 2,400. That is for January. What of for February? In this particular table, we are given that cobalt norm price per ton is 5,900 US dollars, whereas base metal norm price per ton is $5,200. For industrial minerals, the gross value per ton is given as $3,000. In the month of March, cobalt, the price is $6,500, norm price per ton. And then base metal for the month of March is $5,300. Whereas industrial metals gross value is $2,700. Okay, so that's what we have in this particular case. They are given further information in this example relating to production output. For January 2023, cobalt 1,500 tons was produced, and then for February 2,000 base metal tons were produced. For March, 2,500 tons of industrial minerals were produced. Okay, we are also given another table in this particular case to do with exchange rates that applied at the time. So we have month of January, February, and March given as 18 kwacha 50 ngwe, or 18 Zambian kwacha per US dollar, 18 kwacha 50 ngwe, 19 kwacha 20 ngwe for February, and 18 kwacha 90 ngwe for March. So that's what we have. So how do we go about calculating the mineral royalties for this cobalt and mineral royalty tax for cobalt, base metal, and industrial minerals? So that's what we are going to look at. That is what we are going to look at. So I'll prepare some working here so that I demonstrate to you how you do the computation. So I'm going to create a table. Let me use 7 columns and 7 rows. I believe that will suffice. So we look at the first column. We look at the month. That is the month. Okay, month. Okay, and we have month of what? Of 2023. 2023. We look at which month? We have January. January. We also have February. February. We also have the March month, okay, of 2023. So I'll capture also the quantity. So I'll capture the quantity so that I know what is the quantity in tons. So tons, it says that I'm going to capture that. Also, I'll also capture the norm price or gross value per ton. So norm price, or norm gross value, okay, per ton. Okay, that's what I'll capture per ton. I'll also look at norm value. Okay, norm value, okay, which is the total value in this particular case, and also the gross value as in total, gross value as in total for the quantity produced. So then we have also going to look at taking into account the exchange rate. Okay, then we're going to look at mineral royalty tax, mineral royalty tax rate, mineral royalty tax rate. It's very important also for computation. Then we are going to end up looking at what mineral royalty tax is. Okay, mineral royalty. Okay, royalty tax. Okay, so that's what we're going to look at. So in this particular case, we look at this one. This is US dollar. This one is also US dollar. This one should also caps US dollar. Okay, we also have this one, the exchange rate, which is Zambian kwacha per US dollar. Zambian kwacha, okay, Zambian kwacha per US dollar, okay, per US dollar. Okay, so that's what we have, and then we are going to look at the Zambian kwacha. After we have applied that one, this one will be Zambian kwacha. Zambian kwacha. Okay, so that's what we have. So we pick it from there. So what do we have in this computation? We are given the quantities. We are getting the quantities from. We are given the quantities. Here we are. So January we have 1,500. February for a base metal we have 2,000, and then we have 2,500. So look at that. Okay, so 1,500. We have 2,000, and we have 2,500. I believe that is the case. Okay, we have 1,5, 2, and 2,5. 1,5, 2, and 2,5. So we look at what is the norm price and the gross value per ton. So where we get these figures, we are given the norm price and gross value per ton. So for the first one, which is cobalt, we pick the January one, which is 4,800 for cobalt. That's what we see here being included, 4,800. What of for February? February we have February we had produced base metal. So we go look for base metal. We go look for base metal. Under base metal, we have the norm price per ton of 5,200 base metal. So that's what you see here being included. 5,200. 5,200 is being included. Is being included. 5,200 is being included. Then we also have another value which we are going to look at in the following month. We have the industrial material minerals in March 2023. Industrial minerals. So what is the gross value? Industrial mineral for March, it is 2,700. So that's what we're going to use, $2,700. 2,700. Okay, so once we have got these figures, it's a matter of multiplying. Okay, we multiply to get the norm value, which is 1,500 times $4,800 per ton. We are going to get norm value, in this case to be 7,200,000. Okay, $7,200,000. If we multiply for base metal in February, we are going to have 10,400,000. Okay, 400,000. That is within for base metal. What of the gross value for industrial minerals? When you multiply, you are going to have $6,750,000. Okay, that's what we have. That's what we're going to have. Okay, fine. So now, when you look at this, we need to find out what is the exchange rate. So what is the exchange rate? which you need to use. What is the exchange rate to be used? We look at the table for exchange rates. We look at the table for exchange rate. In January, the exchange rate is Zambian kwacha of 18 kwacha 50 ngwe per US dollar. In February is 19 kwacha 20 ngwe per US dollar, and in March 18 kwacha 90 ngwe per US dollar. So that is what is going to be applied. That is what will be applied. So we look at this one. It is first one was 18 kwacha 50 ngwe. The next one is 19 kwacha 20 ngwe. The next one is 18 kwacha 90 ngwe. Okay, so now that's what we have. What is the mineral royalty tax? What is the mineral royalty tax? Looking at these particular norm values and gross values, we go to the table in the exam. You'll be provided with such tables. In the exam, you'll be provided with such tables. Okay, so what we have is this table. You can use this one. Okay, fine. Here we are. So the first one is cobalt. Cobalt attracts what? A rate of 8%, as shown here. Cobalt is the base metal other than copper. The mineral royalty rate is 8%. What of the base metal? The others, other than copper, it is 5%. That's what was shown here in this table. Then what of the industrial minerals? We come to the last row. You have industrial mineral royalty rate applicable is 5%. So that's what we are going to use. So we're going to pick those and apply them. We're going to pick those and apply them. So here the rate is 8%. Here the rate is 5%. The next one is also 5%. That's what we have, 5%. Okay? So now when we calculate 5% of the product of $7,200,000 and 18 kwacha 50 ngwe, then find 8% of that. We are going to end up with Zambian kwacha 656,000 kwacha as a mineral royalty tax. And the same application for the next, which is we're going to multiply in this particular case the $10,400,000 by 19 kwacha 20 ngwe, and then find 5% of the result. We are going to end up having a figure of 9,984,000 kwacha as a mineral royalty. Okay, then we go look at the next one. Okay, the next one, which is the industrial minerals. In a similar manner, we have 6,750,000 US dollars. To convert to Zambian kwacha, we multiply the exchange rate, 18 kwacha 90 ngwe, then find 5%. We are going to end up having 6,378,750 kwacha. That's what we're going to end up with. Okay, so this is how we do calculate the we're going to calculate the mineral royalties. So this is a result of our calculations. It's a mineral royalties. So that's what we have. That is what we have in this particular case. So that's what we have for these minerals. Okay, so that's how simple it is to calculate these particular figures wherever this particular point. Okay, so now we have noted that when it comes to copper, the basis of calculating mineral royalty has changed. So I'm giving you a comparison of the two regimes, the previous regime and the new regime. When I say new regime, I mean the one that is applicable in 2023 under the amended law. Okay, so the previous regime would have this range, say less than $4,500 per ton. The whole amount, the full price, will be subjected to 5.5% mineral royalty tax. And then the next, if the price goes into the range of $4,500 per ton or more, but less than $6,000 per ton, then the full amount will be subjected to mineral royalty tax rate of 6.5%. If it goes to $6,000 per ton or more, but less than $7,500 per ton, then the full amount will be subjected to 7.5%. Okay, and this goes on until you reach the range where you're talking about US dollar 9,000 per ton or more. That was subject to 10% on the full amount. So because of the discrepancies or because of the complaint of the stakeholders, they realized that this particular old regime was not sensitive to operational costs. So they negotiated, or the government came up with a new system which is more favorable to these miners. Okay, because Zambia really depends on the revenue from the mines. So they want to make sure that there is a win-win situation. The miners or the investors don't complain too much, whereas the government also does not lose so much. Because what does it pay Zambia? If the miners had to withdraw, they will lose out the revenue. Equally, of course, the investors will also lose out on the opportunity to make money. So there's an issue of looking at a win-win situation. Hence, a new regime was brought about, which is a sliding rule based on sliding principle, okay, the incremental method. Here, what happens is this: you have the price range. Say if you have less than 4,000 per ton, then a rate of 4% will apply. So incremental price less than 4,000, that will just be 4%. When you look at US dollar 4,000 per ton or more, but less than 5,000, this will consider the interval of 1,000, meaning that the next 1,000 will be subjected to 6.5%. Again, if you cross that threshold, the next 2,000, which is from 5,000 to 7,000, that will be subjected to 8.5%. Then, of course, the last range, where you have US dollar 7,000 per ton or more, that will be subject to 10%. So that's the sliding rule type of principle that we're going to use for copper from 2023 onwards until the income tax, the law changes. Okay, so that's what happens. So now let's look at a bit of an example to see how this one applies. Of course, before I go to that, I've crystallized this to show you the previous regime in more clear perspective. This is what I've already made mention about in terms of the norm prices and the mineral royalty rates, which I've talked about. The previous one before 2023, that's what was used to apply. Less than 4,500, the whole amount 5.5%. Okay, Anything above 4,500 but 6,000, as I've already mentioned, you get to 6.5%, and up to it, the time it reaches, if at all it reaches over $9,000, then that full amount is subject to 10% as mineral royalty tax. This is what the first table is trying to show us. This part of the previous regime, so more crystallized in this particular form. Then we also have this again, the new regime. This one, the new regime, again much more clearer. Put it in this way: mineral royalty sliding scale for copper. As I've mentioned, you have this interval. The first $4,000, 4%. The next 1,000, 6.5. The next 2,000, 8.5. The balance at 10%. That's what is being used currently to determine the mineral royalty tax. So that's what I have in terms of tables. Now again, let's look at these particular situations, the new situation, looking at simple calculation. Okay, example number 2. Let's suppose that we have 100,000 tons of copper fetching $9,300 per ton. So the previous regime would have worked it out this way. Okay, would have taken 100,000 tons, okay, and the price is 9,300 as seen there. Means that it has gone beyond the threshold. Okay, it is greater than $9,000, so it hits the mineral royalty rate of 10%. The whole amount, without exception, the whole amount will be subjected to 10%. So that will be 10% on this amount, 9,300 times 100,000 tons. It will give you 930 million US dollars. So you calculate 10% of that, you arrive at $93 million. So that's a mineral royalty that would have been paid if we are looking at the period prior to 2023 charge year. So that's what happens. But in the new regime, what do we see? The current regime, it is the sliding principle being applied. So you have the $100,000, 100,000 tons. So we look at the first less than $4,000, the first one, which is at 4%. So we multiply that one, 3,909 times the 100 tons times 4%. It will give us $15,996,000. That's what it is. So since the price is 9,300, we still have to go into the next layer of the price, which is 1,000. So the same 100,000 tons times 1,000, and then multiplied by 6.5%, we are going to get $6,500,000 US dollars. Then we have just reached a total of 5,909. We go into the next one, the next layer of 2,000 interval. This is 100,000 tons times $2,000, and then multiplied by 8.5. That will give us $17 million. We still have a balance of 2,301 from the total of 9,000. So I've only used 3,999, 1,000 and 2,000. There is a balance of 2,301 to make up the $9,300. So the last slice, which is $2,301 times the 100,000 tons, it has entered into the rate of 10%. When you calculate the 10%, you're going to find that you have $23,010,000. So then we add from 15,996,000 all the way through to 23,000 and 10,000. We are going to get a total of $62,506,000. That's what we are going to see. So there's a marked difference between the previous regime, which is should have given us to this company to pay $93 million, as opposed to current regime, which is more generous. It gives the investor in this mining operation to pay mineral royalty tax of 62,506,000. So that's the advantage. Okay, so in that way, the investor is given a bit of relief in the current regime. Of course, the government has lost a bit of potential income, but for the purpose of trying to keep the mines afloat, since they have been complaining that mining requires huge investment and they need to recapitalize the mines to keep afloat according to their claims. So the government listened and came up with this type of regime to give them a breather. So we are going to look at another example, example 3. In a similar manner, in this particular case, we have the price of $6,000 per ton and $6,000 per ton. So let's assume that we have a quantity of 100 metric tons, 100 metric tons. So we have the previous regime and the current regime. Okay, we have the previous regime and the current regime. So what happens in this particular case? In the previous regime, we just look at the price 6,000, and what would have happened is just look at the price 6,000. Where are we landing with $6,000 or greater? That attracts 7.5%. So would have been, this company would have been hammered with 7.5% as the mineral royalty tax rate. So you multiply 6,000 times 100, which is going to give you $600,000, multiplied by 7.5, it will give you $45,000 and mineral royalty. Okay. Now in the current regime, what is required is to look at the sliding principle. So the total price is $6,000. So the first 4,000 multiplied by 100 multiplied by 4% to give you $16,000. The next one, which is 1,000, use the price to 5,000. Next slice is 1,000 of $100, 100 tons, metric tons. That will give you $100,000. At 6.5%, that will give you $6,500. Then we go to the last slice, which is the 1,000 to make up the 6,000 times 100 metric tons. That slides into the rate of 8.5. 8.5 of that product will give you $8,500. So if we add, we are going to end up with $31,000. So $31,000 as opposed to the old regime, which would have required a mineral royalty tax to be paid at $45,000. Again, you can see there's some saving there so that the mines can use the savings to recapitalize the mines. They have that benefit. So this is how you calculate mineral royalties under the current regime, which is the incremental method, the sliding principle method. So that's what I've shown you for this particular video. I was interested to show you how you apply or you calculate the mineral royalty tax. How do you determine the mineral royalty tax using the current regime, and also compared with the previous regime. Okay, so that you see the difference and the benefit that could have accrued for this particular mining company. So we come to the end of this particular presentation. I'm very thankful for having listened to this video. Please don't forget to like my videos and also make suggestions on any topic you want to cover in taxation. I'll review some more videos in other subject areas, but for now, I'll really appreciate to get feedback from you so that maybe we improve and I serve you better. Thank you for listening and watching.